Right now, there is probably money in a government account with your name on it. Not a scam, not a prince. A real balance in a real ledger that already belongs to you. Most of it will sit there untouched. The strange part isn't that it exists, it's who benefits every year you don't go looking. Let's get right into it. Number 9, 70 billion in Limbo. Every state in America runs a lost and found. Not for umbrellas, for cash. The Association of State Unclaimed Property Administrators puts the total at roughly $70 billion, belonging to about 1 in 7 Americans. 1 in 7. Look around a crowded bus. 2 or 3 of those people are owed money and have no clue. States do give some back, went over $4 billion in a recent year. Sounds impressive. The pile still grows. And none of it is hidden. The states built a free public search themselves, missingmoney.com. Or go through unclaimed.org to reach your own state's program. 90 seconds, no fee, no middleman taking a cut of your own money. So why does the mountain keep growing? Because most people assume that if someone owed them money, someone would have mentioned it. Nobody mentions it. Here's what should bother you. Nobody broke in. Nobody forged a signature. Tens of billions ended up in government ledgers with real names attached, and almost every owner handed it over the same way. By moving apartments. Number 8, how money becomes abandoned. Picture the most boring crime scene imaginable. A security deposit from a place you left years ago. Your old landlord owed you $200. They mailed a check to the address on file. The apartment you had just moved out of, it bounced back. Now they can't simply pocket it, they have to hold it for a set stretch called a dormancy period, often 1 to 5 years depending on the state, and then hand it to the state. Notice the trigger. Not spending the money, not losing it. Silence, no contact, no cash check, no forwarding address. Old paychecks, dormant accounts, deposits, stocks. The system isn't built to detect theft. It's built to detect quiet. Sometimes the government is the one holding the bag. The Treasury has acknowledged tens of billions of dollars in savings bonds that reached maturity, stopped earning interest, and were never cashed. Bonds bought for grandchildren decades ago, now just paper in a drawer. For years, there was a free federal tool for finding them. It was retired at the end of September 2025, and those searches moved to state unclaimed property offices instead. So the money goes quiet, and the search desk keeps relocating. That's the money you misplace. It gets darker when someone took it on purpose. Number 7, wages already won back. There's a version of wage theft where the good guys win the fight and you still don't get paid. When the Labor Department investigates an employer and finds violations, it recovers the unpaid wages, then it has to find the workers. If it can't, it holds the money for 3 years, and then it's required to send it to the Treasury. 3 years, that's the window. Recent figures put the unclaimed pile above $160 million across close to 200,000 people. A typical payment lands somewhere around $1,300. That's not fun money, that's rent. There's a free search tool with a gloriously bureaucratic name. Workers owed wages. Look up an old employer, then look up yourself. And the reason so much of it rots is depressingly logical. People change jobs, change addresses, change names. Employers aren't careful about keeping details for staff who left years ago. The industries where wage theft shows up most tend to be the ones with the highest turnover. So the government ends up mailing letters to the people hardest to mail letters to, which gives you this sequence. The investigation worked, the employer paid, and 3 years later, stolen wages quietly become federal revenue. 3 years is generous. There's a bigger clock running on money you already earned. Number 6, refunds that expire. Every spring, the IRS publishes a press release that reads like a ransom note written by an accountant. In March of 2026, the agency said more than 1.3 million people still had unclaimed refunds from tax year 2022, around $1.2 billion with a median refund near $686. Then comes the sentence that matters. You generally get 3 years to file and claim a refund. After that, the money becomes property of the Treasury. Not frozen, not held for you, gone. So who walks away from a refund? Mostly people who thought they didn't need to file. Somebody worked part of a year, earned very little, had tax taken out of every paycheck anyway, and figured that owing nothing means doing nothing. But withholding isn't a fee, it's a deposit. Deposits come back when you ask. The median number also hides the better half. For that year, the earned income tax credit was worth up to nearly $7,000 for a household with qualifying children, and like most refundable credits, it isn't automatic. No return, no credit. Sit with that irony for a second. The credit designed for low-income working families is one of the most commonly left behind by low-income working families, because collecting it means filing a return they were told to skip. Same clock every year, same $1 billion, different date on the form. And that's small money next to the pile you built yourself. Number 5, the account you forgot. A company you quit a decade ago may still be holding a small fortune with your name on it. A widely cited study from the rollover firm Capitalize, done with Boston College researchers, estimates there are roughly 32 million forgotten or left behind retirement accounts in the US, holding something close to $2 trillion. That's an estimate, not a head count, but even a fraction of it is a house deposit sitting in a plain you stopped thinking about. The mechanics are aggressively boring. You switch jobs, you mean to roll it over, you don't. The plan changes administrators, statements go to an old address. And if your balance was small when you left, under $7,000, well, your employer may move it into an IRA without you lifting a finger. Under $1,000, some plans simply cash you out and mail a check. A check. To an address you no longer live at. You already know where that ends up. There's finally a government tool for this, the Retirement Savings Lost and Found database, required by the Secure 2.0 Act, running since the end of 2024. In its first year, of roughly 236,000 people who searched it, about 3 in 10 found an old plan tied to their social security number. 3 in 10 from people who mostly weren't sure they had anything. Forgetting money while you're alive is at least fixable. It gets worse when the only person who knew about it is gone. Number 4, policies nobody claimed. Life insurance has a design flaw nobody puts in the brochure. The company doesn't automatically know your relative died. The policy pays a beneficiary, but only after someone files a claim. If nobody mentioned the policy or the paperwork lived in a filing cabinet cleared out during the worst week of your family's life, the money just sits there, quietly owed to you. State insurance regulators built a fix in 2016, a free national policy locator. You enter the deceased's details from the death certificate, participating insurers check their records, and if you're the beneficiary, the company contacts you. Now the number. By September 2025, that one tool had connected people with more than $13 billion in life insurance and annuity benefits. A year earlier, the running total was just over $10 billion. $3 billion found in 12 months. From a search page most people have never heard of. And those are only the wins. The policies nobody searches for don't appear in anyone's statistics. They go dormant, get reported as abandoned property, and join that $70 billion lost and found we started with. Somebody paid premiums for 30 years so their family would be okay. The family never got the message. So far, this has all been money you didn't know existed. Now let's talk about money you were told about. In writing, in an envelope you assumed was junk. Number 3, the 9% problem. You have probably thrown money away this year. It arrived as a postcard with tiny print and a case name you didn't recognize, and it went in the bin between a pizza flyer and a credit card offer. The Federal Trade Commission studied 149 consumer class action settlements, pulling data from 7 of the biggest claims administrators in the country. The median claims rate was 9%. 9 out of 100 people who were mailed a notice, told a company had wronged them, offered actual money, and 9 filled out the form. Format barely helped. Mailed packets with a claim form enclosed came in around 10%, postcard 6, emails 3. And here's the detail that should bother you. The claims rate didn't track with how much money was on offer. That tells you people aren't weighing whether it's worth the effort. They're not opening it at all. 13% of notices never even arrived, and where administrators could measure it, only about 14% of notice emails were opened. So where does the rest go? It depends entirely on what the settlement agreement says, to charities under the CI-PRED doctrine, to a state unclaimed property fund, to a second round for people who did file, or in some cases, back to the company that got sued. That last one deserves a moment. The headline reads, "Company pays $60 million. Some of that money never actually leaves the building because the people it belonged to assumed the envelope was a scam." Which is understandable. You learned that distrust somewhere. Probably from a hospital bill. Number 2, bills you never owed. More than half the hospitals in America are nonprofits, and that status isn't a personality trait. It's a trade. Under a section of the tax code added by the Affordable Care Act, tax-exempt hospitals must have a written financial assistance policy, cap what they charge people who qualify at the amounts generally billed to insured patients, and make an effort to check eligibility before aggressive collections. You usually get at least 240 days from your first bill to apply. Applying doesn't hurt your credit. While a complete application is pending, extraordinary collection actions have to stop. A national analysis found the median cutoff for completely free care was about twice the federal poverty level, with discounted care often extending higher. That's not a program only for the destitute. That's a serious slice of working America potentially qualifying for free or reduced care. on paper. In 2018, executives at Providence, one of the country's largest nonprofit chains, decided free care was hurting their bottom line. With help from McKinsey, they built a program called RevUp, a playbook for extracting payment from patients, including patients entitled to free care. When people didn't pay, debt collectors followed. Staff were trained not to accept the first no. One employee warned leadership they were sending the poor to bad debt. Washington's Attorney General resolved it in 2024 for $158 million, refunds with interest for tens of thousands of patients, plus debt forgiveness for tens of thousands more. Those refunds exist because the state government forced them. Where nobody forces anything, the bill just stands. Number 1, keeping the change. Geraldine Tyler was 94 when her case reached the Supreme Court. She'd bought a one-bedroom condo in Minneapolis in 1999 and lived there alone for over a decade. Then she moved out. Nobody paid the property taxes, and by 2015, the bill had grown to roughly $15,000 with interest and penalties. The county seized the condo and sold it for $40,000. The debt was $15,000, the sale was $40,000. The county took the $15,000 it was owed and kept the other $25,000 too, not through a loophole. Minnesota's forfeiture law sent that surplus to public entities, county parks, memorial forests, the local town and school district. It was the plan. An elderly woman's life savings in that home converted into a line item for public landscaping. On May 25, 2023, the Supreme Court ruled unanimously in her favor. Keeping the surplus violated the Fifth Amendment's takings clause. As Chief Justice Roberts put it, the taxpayer must render unto Caesar what is Caesar's, but no more. 9-0, which tells you how clear it was and how long it ran anyway. Now here's the thread under this whole video. Nothing on this list was secret. Every single item had a public database, a legal right, or a printed policy behind it. What they share is a default setting. Stay quiet, and the money stops feeling like yours. California's own legislative analyst's office once put it plainly, because unclaimed property that isn't returned becomes general fund revenue, the law gives the state an incentive to reunite less of it. That's the machine. Nobody has to take anything from you, they just have to wait, quietly, while you assume that anyone who owed you money would surely have called. Nobody's calling, go search your own name. That's all for today. I'll be making similar videos in the future. Subscribe to see them.